Have you ever wondered what happens when the world's smartest money has too much of it? There's too much cash, not enough flow. When the exits are blocked and when the assets are aging, the investors, the limited partners, are getting limited as well in terms of patience. So they're wanting an exit. What you have to understand is we're not going into a private equity crash, so to speak. We're more in a liquidity trap. We're in a log jam. So to use that, analogy of cutting logs, putting them into a river and letting them flow downstream, from an IPO to an exit, or from an acquisition to an exit. Now there's a build-up of these companies and of these companies that have to have an exit for investors to see money. So we're in a glorious $1 trillion traffic jam. And today we're going to navigate a bit through the different parts of this and what that looks like in this great private equity liquidity trap. This is the story of record-breaking dry powder, exploding secondaries market and continuation funds, and an industry that's looking to get creative, dry powder and a complete lack of places to put that dry powder. So if you think private equity is just still about quick flipping and easy exits, cheap debt, you're in for a huge awakening now. Let's strap in. This is Deal Flow, and we're going to be analyzing this. Let's look at the scoreboard, shall we? So, on the surface, 2025 started with a bang. According to Robes and Gray, US private equity deal value was up 30% year on year through August, and we saw monster deals like Sycamore Partners' $23 billion acquisition of Walgreens Boots Alliance. Deal value surged 40% from EY, according to EY as well. And this isn't really a healthy rally. It's more of a controlled demolition, like explosion, basically. And the big players are doing two things. They're having fewer deals and they're having bigger deals because they can afford to. This is where they see their biggest returns, right? The data shows mega deals, so $500 million plus, only saw 22% drop in investments, the smallest of any group, but the exits collapsed by 43%. So they're holding on for dear life. And here's the rub. All this activity isn't leading to realizations, it's leading to a warehouse. The industry is sitting on a mountain of $1.2 trillion in dry powder. Nearly a quarter of that capital has been sitting unspent for 4 years or more. That's not patience, that's paralysis. Look at this. I mean, this isn't a strategic reserve, it's a walk-in freezer. You can't just keep shoving companies into the bag and hope they age like fine wine. Most of them will spoil, they'll go off over time. So what's the solution? The side door solution. When you have the IPO, the front door is wide open and there's many entering the top of the funnel, but the back door's closed, so there's no exits. You have to create another way to release that pressure. You have to create a side door. This is where secondaries and continuation funds come in and why they're booming right now. What does a smart financier do in this situation? So it's a bit of a financial alchemy. A firm like Blackstone and KKR, they take a company from one of the older funds that's doing well but isn't ready to sell yet, and they move it into a new fund they've just raised. So it lets them reset the clock, return some cash to impatient investors in the old fund, and keep managing the asset for another 5 to 7 years on average, right? Some maybe quicker, maybe 3 years, some maybe longer, 7 or even 9 years. And what do you think that this means? It's kind of considered like a financial cross-stitching. So it's you're moving the same bloody turkey from the freezer to the fridge and telling your dinner guests it's a new dish. It doesn't solve the liquidity problem, but it raises the massive question of who's making sure that the price is right. Speak of the devil. Even if he thinks Yeah, right. As I was saying, this isn't just innovation, it's a financial duct tape. So where's the money actually flowing? What are the hot sectors right now? In this environment, you don't buy flashy, you buy fortresses, you buy slow, solid assets. Forget the metaverse. The smart money is now making a retreat into more stable growth. Where's the action? Boring, essential, cash generating businesses that are recession proof. There's a huge uptick in demand for these, and we're noticing that by family offices in Europe, family offices in the United States, private equity, um, search funds. There's this huge pivot to boring businesses that is really taking off. Private equity has tracked 118 deals in that sector since 2020, building an estimated $30 billion in new value, at least. That's what's on record, but you can be sure there's a lot more going on that's not fully on record, right? Firms are buying up regional CPA firms at valuations up to 15x EBITDA. So you see firms like New Mountain Capital took 60% stake in Grant Thornton's US advisory business. Another example, BlackRock led a group that bought into Citrin Cooperman, roughly $2 billion valuation when they're buying in. So why? Because these firms with sticky client relationships, recurring revenue, they're essential businesses. They're always in demand, these financial services companies, and everyone needs the taxes done, right? So it's defensive. It's a defensible bunker. It's a fortress that will last years. And every single one of these boring businesses, the new magic word isn't leverage anymore. It's AI. So the top firms aren't just financing engineers anymore. Look at Thoma Bravo, world's largest tech buyout firm with $184 billion in assets. They don't just buy software companies. They use their own operational expertise to drive innovation and to integrate AI into the workflows of the company. So if your private equity firm isn't doing this, you're not cooking with peanut oil, so to speak. You're cooking with canola oil, right? So the quality is just, you're not getting the max performance out of what you're cooking with, basically. You're cooking with a blunt spoon. So what's the road ahead? What are the lights in the tunnel of this kind of bottleneck in the deal flow? Can this $1 trillion traffic jam ever break? And will it? What would that look like? Okay. There's two parts we have to take a look at. One is the Federal Reserve rate cuts. Okay. So there are signals. The markets are pricing in interest rate cuts, which could make financing easier and exits more attractive. The IPO pipeline is firming up, so offering a potential escape route there. The relentless pressure from pension funds and endowments for their money back is probably 9 out of 10 that it's a fever pitch. And the biggest, most controversial change on the horizon has to be 401ks. So the gates are slowly opening to allow this massive pool of retirement money. I think it's $8 or $9 trillion into the private equity markets. We're talking about tapping into trillions and trillions of dollars here. Even a tiny slice of that tsunami of new capital could either fuel the next boom or complicate this mess beyond belief. But here's our raw takeaway. The era of buying a company, loading it with cheap debt, and flipping it 3 years later, it's over. The winners are now operators. So we're seeing firms with real solid sector expertise like TA Associates in growth equity or Insight Partners in software. The ones who can actually run a business successfully, not just rent one, strap it up with debt and, take the value out, right? So what have we learned? The machine is running, but it's circling the track. Demand is redlining. Private equity markets are full of dry powder, and there's the car's redlining on the track, but it's looking for a stop, and there's not one. So it's creating complex and increasingly interesting side door solutions, ways to unlock the value and unlock the capital, give investors what they're looking for in terms of a return, and betting big on the unsexy, essential parts of the economy, the hard assets, the real, defensible parts of the market. The game has irrevocably changed from financial engineering to operational engineering or operational expertise. It's brutal, it's messy, and for those who understand it, it's utterly fascinating because this isn't the end of private equity. It's the most demanding chapter. This is where demand takes this to a new level, and we see, this may be the height of the next few years in private equity. This may be the most interesting chapter so far, and super curious to see what happens next. If you're an investor watching this, do your homework. Look past the brand name to the portfolio. Look for the firms with real operating partners, not just spreadsheet jockeys, guys good with Excel. The deep end is only for those who can actually swim. Until next time, do mind where you park your capital. Thank you.